Without further ado, please join me in welcoming David Van Deynze.
How about now? There we go. That sounds better. Good afternoon, everyone, and thanks for joining. So I've been asked to talk about data, and obviously MASC has been around for a long time and has a wealth of data that can be used for a lot of different things. And what I'm hoping to do today is show you a little bit about things that we do with the data, hopefully some things that you can take away as a farmer that might help you a little bit, make some decisions on the farm, and understand a little bit about what we think, what direction farming is going these days in terms of size and that sort of thing. So to set that stage, a little bit of history, how long we've been around, kind of data that we have within some different time slots. Spend some time about reseeding. Reseeding is always a tough decision to make for farmers. We'll show a little bit about what some of our data shows in terms of timing of reseeding and that sort of thing. Lots of discussion about farm size and what's the right farm size to have. So we'll take a look at farm size from a risk perspective and how we see farm size impacting our crop insurance program. Similarly with crop diversity, what's the right number of crops to grow on your farm? There's tons of crops to grow. Do you grow the one or two that you're really comfortable with? Do you expand that a little bit? And I'll show you what we see happening from an insurance perspective. Similarly with yields over time, obviously yields are increasing every day. We'll show you what our data looks like from that perspective and how that impacts premium rates. With yields going up all the time, does that change the risk profile a little bit for the insurance program? So we'll give you an idea about that. And then lastly, just a couple of slides about, if you are interested in any of the data that you might see here today, where you can find that. So we've been offering crop insurance way back to 1961. Of course, in 61, data looked a lot different than it does today. We used to calculate every farmer's coverage and premium with a calculator and a piece of paper back in that timeline. Thankfully, we don't do that anymore. Since about the mid-90s, what was Manitoba Crop Insurance Corporation finally got into the computer world a little bit and made our lives a lot easier from that perspective. But that's really when the whole data picture took off for us. What we could collect, what we could use, what we can analyze. So a lot of what we're going to talk about today really starts in that mid-90s kind of time frame. And what we're trying to do these days, so we built some computer systems in the mid-90s. We're still using some of those today, which are not ideal in today's data world, so we're trying to modernize our data infrastructure. We're about halfway through that. We're still using some systems that were built back in the 90s. Got a number of new systems that are much more current and a lot easier to use and doing a lot better work for us. So if we think about that 1990s sort of time frame where we have a lot better data, in the mid-90s we were insuring about 6 million acres. Today we're insuring somewhere around 10 million acres. So the level of data we have today in our system, so since the mid-90s, we know on every field what the crop was, we know the seeding date, we know the harvested yield, we know if there was claims on that data. So very specific on what we have. From a client perspective, we know how many lost years they've had, we know how many times they didn't have claims, we know what their loss experience is, so sort of that premiums compared to indemnities, type of calculation. So a lot better picture since the mid-90s of what we can have and what we can analyze. So that's a great thing. First thing I thought we'd talk about is that reseeding question. Always a tough question for farmers, to reseed or not to reseed. Things to worry about. What is the crop we're talking about? What's the original seeding date? How bad is that crop that's in the ground right now? And that's maybe what we'll focus on the most. But other things they got to worry about are the current field conditions. If I do put a new crop in the ground, is it even going to come up? If it's a dry situation, that might not work out that well. And what's the date on the calendar? When did I put that first crop in the ground? And when am I going to be able to reseed? And what does that really do to my yield potential? So this is a standard sort of plant density curve that I stole from the Canola Council of Canada. And really this is in plants per square foot. So if you get in that 5-6 plants per square foot range, you typically get somewhere around 100% yield potential. That's enough plants to get a full crop is essentially what that's trying to say. Even if you cut those plants in half down to 2 or 3 range, you're still at about 80% of a crop potential. So even though you only have half as many plants as you want, it doesn't mean you're going to have half as much yield as you were hoping to get. So farmers need to keep that in mind when they're looking at a crop like canola. Here's basically the same situation or the same data from MASC's perspective. This is our plant count sheet that our adjusters use when they're going out to do some appraisals. It's in plants per square meter, so it's not lining up exactly right. There's almost 11 square feet in a square meter. But for our adjusters, if they find 41 or more plants in a square meter, that's 100% of a crop. Even if you cut those plants in half, you're still potentially up for 80% of a crop. So again, something that a farmer needs to keep in mind. Only has half as many plants as they hope to have, and yet there's still a potential of an 80% crop there. So need to keep that in mind. That's one piece of the puzzle. The second one that we'll look at a little bit is related to the date that that crop is in the ground. And we're just going to look at all the data that we have for this canola area 1, which is this sort of southern, mostly southern part of Manitoba, is what we're going to look at here. So this is all of the yield data that we have by seeding date from 1996 to 2024. And this basically says as long as you seed canola sometime before the 30th of May, you can expect a full crop potential. Probably no big surprise, but that's, farmers would know this as well as we do. You can seed a little bit earlier, seed into May, you're doing really well. What we see in those first sort of 5 days of June is about a 7% yield drop in that timeline. We take that out a little bit further in that canola area, the next sort of week or so of June, we see that dropping down to about a 10% yield penalty, I'll call it, for seeding that little bit later. One more step further into this June 11th to June 15th, we're down to about a 15% drop in yield potential. And if you're familiar with our insurance program and within that area, we have a canola seeding deadline of June 15th. So if you seed by June 15th, you're eligible for 100% coverage of on your canola crop. Even though we know that if you're in this timeline, you're still down to about 84% of a crop potential, typically on average in most years. But again, if you recall, we offer producers at most 80% coverage, right? So this is based on 100% of a crop. We offer you 80% coverage. You're still over coverage if you seed in this timeline, and that's why this is a reflection of what our full coverage seeding deadline is. We do have an extended coverage seeding deadline period of June 16th to June 20th that starts to get below that 80% magic number. So you seed in this timeline, you basically, the coverage that we offer is 80% of 80%, and that's why we allow that to happen in there. We reduce that coverage to reflect a lower yield potential. So if you're a farmer at the end of the day, you need to firstly think about how many plants do I have left that are going to make that crop, what we talked about earlier. And if you've got a crop potential in terms of number of plants, it's still going to get you somewhere in that 80% range because you seeded it in the middle of May, but you've got fewer plants, so you're still targeting 80%. If you're thinking, well, why don't I reseed? Maybe I'll get 100% of my plant population. But if you're reseeding into this time frame, you're still working with 80% of a crop regardless. So you have to make that decision as a farmer. Do I want to keep the 80% potential I have today, or do I want to go after a different 80% and try and get a better plant stand, but recognize that I've really shortened my growing season and probably maxing out at 80% anyway. So again, thankfully it's not a decision I need to make typically. It's one of these tough ones that farmers have to make all too often, but it's a combination of plant stand and timing of that second crop going in the ground that they need to consider, among other things like how dry is that crop. Is the second crop even going to get out of the ground if you're going through a dry period, that sort of thing. So lots of challenges, but we hope data like this can help inform a farmer's decision whether or not to go ahead and reseed. Show you similar data for soybeans. This is our plant count process for adjusters. We do this measurement in 1/1000th of an acre because soybeans are often a row crop. So we look for 140 or more plants in 1/1000th of an acre, we consider that to have full crop potential. Similarly, even if you cut that plant number in half, roughly, you're still at 80% crop potential. So again, no secret here, plants have an amazing ability to take up the extra space, nutrients, sunlight, those kinds of things that are afforded to it when it's a little bit thinner, and they respond by producing even more yield on a per plant basis. So again, nothing too earth-shattering here. We're going to look at all of our data that we have for Area 3, which is mostly in the southwest corner and a little bit in sort of what I'll call maybe the fringe, or what were originally considered to be the fringe growing regions for soybeans. Traditionally, I think soybeans were mostly in the Red River Valley, certainly lots of soybeans across the rest of Manitoba nowadays, and we'll look at that data that we have for Area 3. So similar story, just a shift in the timeline a little bit. We see a full crop potential for soybeans happening when they're put in the ground prior to this May 20th timeline. Start to see a bit of a yield drop when you get into May 20th to 25th. We're down about 6%, down about 13% if we're into that last sort of week of May. And that first week of June, we're down to 20% or so. And we have an extended coverage seeding period for if we're into this June 5th to June 10th. So you can see a little bit of difference here. Arguably, our extended coverage seeding period deadline should start June 1st, because that's at the point where it drops below that 80% coverage that we talked about with canola. But I would say, giving farmers maybe a little bit of a bigger window and a little bit of the benefit of the doubt to allow them to have that extra coverage even seeded up to that June 4th timeline in that area, as soybeans continue to develop and expand as we go further west. So, the same sort of concept with this extended coverage seeding period, recognizing a lower yield potential seeded in that area, but still want to give the producers that option to plant the crop in that timeline and still have insurance. So same deal, I think, from a farmer's perspective. If their soybeans planted early, didn't come up, or doesn't have the plant stand that they hoped it would have, really need to consider how yield starts dropping off before they decide to replant soybeans, and understand exactly what they're in store for based on our long-term data. I thought next we might start talking about the size of the farm. And there's always that age-old debate about what's the right size of farm. We talk about efficiencies in large areas, or larger farms having efficiency in some cases. Arguably, if you have a small farm, you could say you're just as efficient because you still have the right equipment to deal with the number of acres that you have. Some small farm operators say, hey, I can pay better attention to detail on my land. I don't have so much land. I know exactly where every pothole is. I know exactly where every large stone is. I know exactly what I'm dealing with. That's harder to do if you've got a huge land base, perhaps. Availability of labor, I think you could argue, is a challenge in most farms these days. If you've got a large farm, you certainly need a much bigger staff to make it happen. Some small farms, for example, people have full-time jobs and they're trying to do it evenings and weekends, and availability of labor is a challenge in that sense as well. Management resources is always an interesting one. A lot of farmers start off farming because they love it, they love the tractor, they love growing crops. Sometimes they grow to a point where all of a sudden they've turned into a manager. They're hiring people, they're dealing with people, they're no longer driving tractors. So management resources can be a challenge depending on the size of the farm. Equipment availability. On a small farm, you may not be able to own every piece of equipment that you'd like to own, just because the economics don't make sense. So there's that challenge as well. Access to capital. Again, this could go both ways. If you've got a small farm, the bank may or may not be that interested in lending you money. If you've got a large farm and you're already leveraged to a certain extent, you might have that same challenge. Geography could go either way, but typically with large farms, the spread of geography is much bigger. So from an insurance perspective, if you've got fields that are 5, 10, 15, 20 miles apart, that does spread risk, we believe, from our perspective. Different soils, different weather patterns that may or may not impact your farm differently. So there's lots of things to consider. At the end of the day, we're going to just start by showing how farm size has changed across Manitoba over the last 30 years. Again, nothing really surprising here, just confirming that our data shows the same thing that I think we all believe. Back in 1996, we were insuring over 11,000 clients, farmers in the insurance program. We only had one farm over 10,000 acres. Most of them, in this, what it would be 80% range, were 1,000 acres or less. The average farm size was 690 acres. What's interesting, and again, no surprise here, the number of farmers in this less than 1,000 acres has been shrinking over the last 30 years. Again, not a surprise to most of us, I'm sure, but maybe surprised me a little bit is the farm size in this 1,000 to 500. The number of farmers grew in the first 20 years of this data picture, but actually shrunk a little bit in the last 10 years. Fewer 1,000 to 5,000 acre farms in the last 10 years than there was 20 years ago. And obviously the larger farm groups have been growing substantially over that timeline. So at the end of the day, that our average farm size has changed from 690 acres 30 years ago to 1,460 acres in 2025. And now, although we're insuring more acres than in 1996, we're doing it with just a little over half the number of farmers that we were dealing with back in 1996. Again, no surprise, but nice to see it sometimes in real data. So I think what's more important at the end of the day is having a look at what farm size and risk really means from our perspective and what our data shows. So we looked at all of the data that we had for farmers from 2003 to 2024. And we looked for insureds within that time frame that had at least 5 years of data with us. Just made it easier to consistently say what size of farm they were rather than being in and out and that sort of thing. So at the end of the day, that meant we looked at data from 12,253 farms, at the crops that they grew, and also included the 2 wet to seed data. So the first thing we looked at is how often does a farm put in a claim on a crop? And basically what we found, small farms claim more often on a per crop basis than larger farms do. And there seems to be a bit of an up and down situation, sort of a sweet spot in here. So small farms claim most often. We start to see it drop off, and in this 1,500 to 4,500 range seems to level off, and then starts climbing a bit, where larger farms, bigger than 7,500 acres, start claiming a little bit more often again. So based on our data, just from how often they claim on a crop perspective, seems like there's a sweet spot in here in this 1,500 to 4,500 acre farm sort of thing. Now that's interesting, and of course, insurance programs don't always look at exactly how many claims they have. What probably is more meaningful is how big are those claims? How much money are they collecting from the insurance program relative to the coverage that we're offering? So we looked at farm size based on LCR, which is the loss to coverage ratio. So if you have coverage of $500 an acre and you have a $100 claim, that's a 20% loss to coverage ratio. So again, we're finding smaller farms have a higher loss to coverage ratio than larger farms. And it seems like that sweet spot kind of carries through again somewhere in this 3,000 acre range. It seems like is where it really levels off. And whether you're a 3,000 acre farm or bigger than 7,500 acre farm, your loss ratio is essentially the same. So it's, from MASC's data perspective, if you're a small farm, you have a higher loss to coverage ratio. That starts to shrink till we get to roughly this 3,000 acre area, and then there's not much difference after that. So farm size matters to a certain extent on the relatively small size, but once you get into this mid-size range, it doesn't seem to matter if you get into the large or the mid-size. So that's purely on the number of acres. Now there's some argument around the number of crops. So if you're a bigger farmer, are you growing more crops? And if you do grow more crops, what does that do to your experience with MASC? There's a couple of schools of thought. If you're a really good wheat grower, why don't you just grow wheat because you're good at it and keep on doing it and you focus on what you do well rather than trying a whole bunch of different crops. That's one way to look at it. The other way could be, well, maybe you should spread your risk, right? If all you do is you grow wheat and it's not a great wheat year, you might have wished you grew canola, soybeans, something else, just to spread that risk a little bit to ensure that your farm stays profitable. And really doesn't matter what those crops are and some different crop groups that we'll talk about in just a second. So if we look at those same 12,000 or so farms that we identified earlier, about 10% of them only grow one crop. And this doesn't mean that they only grow one crop ever. This means, it could mean they grow wheat in 1 year, canola the next year, soybeans the next year, but all their acres are in one crop. All wheat 1 year, all canola the next year, all soybeans the next year. So it's not a rotation question here. It's really about a focus question on their farm. So about 10% only grow one crop. You know, in this 25% range for each of these categories, growing 2, 3, or 4 crops. And then you get down here, another 10% or so grow 5, and somewhere under 10% are growing 6 or more. So it seems like the most common thing producers are doing are 2, 3, or 4 crops, trying to focus on that number, which again makes sense, and I think intuitively we would see most commonly on a lot of farms. So what's the impact of that crop diversity on our loss to coverage ratio? So again, same sort of loss to coverage ratio idea. Farmers who only grow one crop show the highest loss to coverage ratio for MASC insurance. As you get into 2 and 3 crops, it starts to drop off, and then it levels off here when you get 4, 5, and 6 crops. Now this data, from MASC's perspective, red spring wheat's a crop, northern hard red spring wheat's a different crop, durum's a different crop. So you start to think, maybe we should put this into crop categories instead. So we looked at crop groups, and we made 4 different groups. One group is cereals, one is oil seeds, one is pulses, and one is forages. So we looked at what that LCR looks like. If you just stick within one group, and we'll call it cereals in this case, and it's not necessarily cereals, but you're only growing one crop, again, for one crop group, you have the highest LCR in MASC's experience. If you're expanding that and growing 2 of them, it certainly drops off. You get into 3 or 4, that's even better. So from an insurance risk perspective, it's showing up for us that if you can diversify and get out of and get into 2 or 3 different crop groups, it's a benefit for MASC in the long run. So the question becomes, all right, if I've got a big farm and I diversify my crops, MASC is saying that that's good for the program. That's, so do I get a premium discount because I've got a large farm? Do I get a premium discount because I grow 6, 7, 8 crops? Well, the reality is we have a matrix for calculating premium discounts, and don't spend too much time trying to figure this out, but really what it says is if you're a farmer who doesn't have very many loss years, and or you're a farmer that has a good loss ratio, doesn't matter how you got there, how big your farm is, how many crops you grow, but if you don't claim that often and you've got a low loss ratio, you're going to get a discount from MASC. Doesn't matter how you got there, but that's what's important to us. On the other side of the equation, if you have a lot of loss years and you've got a high loss ratio, you could have a surcharge on your premiums. Again, not necessarily a reflection of your farm size or of the number of crops you grow. It's really a reflection of your experience with MASC specifically. So we believe we do react to those farms that are performing well, regardless of how they got there. Our data shows the larger farms perform a little bit better, and the ones who grow more crops perform a little bit better. But that doesn't necessarily mean that's the reason that they're into the discount or surcharge type of area. So the next thing I thought we'd chat about is where are yields going? So we have yield data back to 96 and back to a lot longer than that on an average, area average sort of basis. So arguably this is the strength in our data. Is the yield information that we have. And where are yields going? Technology's obviously played a huge role in that. Farmers are better able to place the seed exactly where they need to, the fertilizer exactly where they need to. The input products are better than ever. Farming practices, we know how to manage our land better than we ever have, whether it's heavy clay soil, lighter sand. Farmers are doing better jobs all the time managing them appropriately. But breeding programs are better than they've ever been. New varieties coming out all the time, always making better varieties, higher yielding varieties. And of course there's this discussion around climate change, and I'm the furthest thing from a climate change expert, but it is having an impact. It is real. What we're trying to figure out is if climate change is hurting things, to what extent are we able to overcome that through some of these other improvements? Or maybe even climate change is making growing crops better in Manitoba, as we're sort of on that fringe northern area for growing crops. So again, if you're familiar with our program, the average yield or the coverage that we offer farmers is based on a 10-year average. We look at the average yield that they've grown over the last 10 years, and we use that as the basis for what their coverage is going to be. So I thought I'd look at two different increments of 10-year averages. This first graph shows 2005 to 2014, and this is for red spring wheat. And we put in this trend line in the middle of these average yields. So these are provincial average yield dots, what the provincial average yield was for each given year, and then the trend line shows what's in there. So you can see yields are trending up. Again, no surprise, this is 2005 to 2014. Really good, started in this, just under 40 as an average yield and ended up just over 50. So in that 10-year period, really exciting improvements. Here's the next 10-year period, and this 10-year period is essentially what farmers' confirmations are going to be based on. We'll be mailing out confirmations here in the next couple of weeks, and we'll be using data from 2015 to 2024. And this is what it looks like. Again, still trending up. I would argue not at the same sort of slope as it was the 10 years previous. So it seems like we're not improving yields at the same pace that we were in the previous 10 years. But again, still heading in the right direction. So that's encouraging for sure, but not quite at the same pace as it was. And this is meaningful, I would say, because in our program, when we were looking at the data like this, rather than using a straight 10-year average, we were adding what we called yield trending. So we were recognizing how there's a continuous improvement. And we did that because of a trend line like this in wheat. What we're finding is that's leveling off, so we're having to back off in the last couple of years what our yield trending factor is. So we're getting closer to a straight 10-year average again, like we were historically, and slowly, I'll say, removing that trend factor that increased the overall 10-year average. So this is the picture for wheat. Similar story for canola, at least in the first 10-year period, 2005 to 2014. Really good slope. Yields kind of climbing from sort of 30-ish to 36, 37-ish. Again, the right direction in that 10-year period. Very different story in the last 10-year period. Now, I don't think it's fair to say that we're going backwards. A tough year in 2021 obviously influenced what this trend line looks like. But if nothing else, sure seems to be flattening off, and we're not seeing in this last 10-year period the same sort of advancement in canola yields that we saw in the 10-year period prior to that. What does oats look like? Again, really fairly steep curve here with oats. In 2005, we were in this 70, 75 bushel range. By the time 2014 comes around, we're right around 100. So some great improvements there. Still seeing some improvement in oats, but definitely leveling off again. Perhaps 2021 yield is influencing that trend line as well, but I think safe to say certainly flattening out a little bit, not seeing the same growth in yield potential that we were seeing previous to that in the previous 10-year period. Grain corn, again, 2005, 2014, some great years. Had a tough year in there in 2009, but still showing a really good slope. Used to be in that 90 bushel average range. Then by 2014, we're in that 120 bushel average range. Grain corn really flattening out as well. So kind of staying 120, 130 bushels here over the last 10 years. So not seeing that same slope or level of improvement. Seems to be leveling off as well, like the other crops we've seen. And finally, soybeans, 2005 to 2014, again, a pretty good jump, 26, 27 in 2005, and over, about a 10 bushel increase in that timeline based on that trend line. Again, leveling off a little bit in that next 10-year period, not quite a 10 bushel difference, maybe more in that 7, 8, 9 kind of bushel difference. So, again, seeing some improvements, but not to the same extent that we were previous to that. So if we think that yields are ever increasing, And they certainly are, and we hope that that doesn't stop. I mean, they need to keep going from that perspective to make sure farms remain profitable. But what does that mean from an insurance perspective? Are we worried about that? We're offering more coverage today than we've ever offered because probable yields are going up, average yields are going up. Does that mean our risk is increasing? So we looked at this in this particular way, and this is red spring wheat, and we've just expanded the timeline. So this is back to 1970 to 2024. And you can see a nice slope, pretty steady slope back in the 70s, you know, an average crop was in that 30 bushel range. And now, of course, it's well over 60. So huge improvements, that's fantastic. So in that timeline from 70 to 2024, obviously we're offering way more coverage because coverage is based on producers' average yields. So we're offering way more coverage. Does that mean we've got more risk? Potentially, but if you've got a keen eye, you might notice there's a few dots missing in our line here. What we've done is we've pulled out, I'll call it claim years, to suggest here's the average yield in good years, and here's the average yield in poor years or challenging years. So what we're looking at is, has that gap changed between those two? And for wheat, that gap hasn't changed a whole bunch. So plant breeding, technology, all of those things are making yields way better, but it's also making yields better in challenging years as well. So back in the 80s, we'll say, if we had an average yield of 30 and a claim yield of 20, we were paying about 10 bushels an acre for that loss. Here we are in 2024, average yield of maybe 58 and in a good year, and in a poor year, maybe 45. So rather than 12, maybe we're at 13, 14, maybe 15 bushels as a difference between good and bad. Risk not changing a whole bunch for wheat. Slightly, but not a whole bunch for wheat. So that's a positive thing. It doesn't automatically mean because we're offering higher coverage that we have higher risk, because the technology, plant breeding, farmers' practices have also improved yields in challenging years as well. Same graph for canola. Again, canola yields since 1970 to now used to be in that 20 bushel range, and of course now in that 40, 45 bushel range as averages. What does the average look like for the poorer years, I would say? Again, this gap's a little bit bigger than it was for wheat. You know, we used to see, I don't know what that would be, 10, 15, 17 bushels maybe, difference between good and bad back in the 80s, and now we're closer to 20. So again, not drastically different by any stretch, but you know, slightly more risk, I would say, because these yields, farmers, because there's so many more red dots than blue dots, farmers' coverages are mostly based on years with good yields. But claims are based on the difference between those two. So as that gap widens, we believe there's slightly more risk in these crops. And it's something we need to be mindful of, because at the end of the day, it could impact our premium rates. Oats, a really steep curve for oats. Back in the 70s, you know, 50 bushel oat crop was normal. Now we're into that 120 bushel range. Again, so some great improvements in the oat world. But here's a crop where that gap is certainly widening, right? So when we look at this, yeah, the difference between good and bad oats in the early years, not too significant, but that gap is a lot wider now. So technology is taken to the place where when we have a good oat year, it's really good. When we have a poor oat yield, it's quite poor relative to the good years. So from our perspective, might be showing that there's a little more risk in the oat world than there used to be, based on the improvements to varieties and that sort of thing. Grain corn back in the 70s, 50 bushel crop, not all that abnormal. Now we're into 140, 150 bushels. So huge improvements in grain corn yields over that 50-year period. What does the poor yields look like? This blue line, again, that gap is a fair bit wider nowadays than it was previous to then. So risk slightly bigger because yields are great when it's good. Yields haven't kept up to that same trend line when it's a challenging year. So another crop to keep an eye on. Soybeans might be the most interesting. Now, something to note, soybeans haven't been around in Manitoba here for all that long. So we only have data really that's usable back to the late 90s, early 2000s. So we look at that trend line for that data, much shorter data period. But here's what soybeans looks like, and you can see it's the opposite of anything else we talked about today. That gap was a lot bigger back in the early 2000s, a little bit narrower now as we get closer. That could be due to a lot of things. One, maybe just a shorter time series for data. Two, the expansion of soybeans. Back in the early 2000s, we had 50,000 acres of soybeans insured. Now we're at 1.5 million or 1.3 million acres. So there's a data component here that I'm sure is somewhat playing with these numbers, but soybeans, arguably the good news story here. So if we think about where premium rates are going, so we've showed yields going up, we showed some challenges in different things, different areas. From MASC's perspective, of course, we're a Crown Corporation. Our intent is to balance premiums over time. So we're not in it to make money. We're collecting premiums for the sole purpose of paying claims. So there's no profit margin in and that kind of thing, which makes our life a little bit easier. So anytime we see an increased risk, that means increased premiums at the end of the day for those things to level off. And that's the only reason for us to increase premiums is if we see an increase in risk. So I thought, let's take a look at the last 25 years. This solid black line is what our premium rate has been, and that's just a trend line of which direction it's going. So the trend line shows up, and it shows a pretty sharp decline over the last 25 years from a trend perspective of where premiums are going. So, that's really exciting from my perspective. I thought, man, if that's what the trend line looks like in 25 years or in the last 25 years, what's this going to look like back to 1970 or even 1960? Much different picture. You can see overall our risk hasn't changed that much. We started with premiums on a trend line perspective in that 8% range. They bounced up and down, and we're still in that 8, getting closer to 9% range on that trend line. The actual black line you see is certainly going up and down, and if you've been farming for a while, you'll probably recognize we had some really good years through the 70s, so our premium rates dropped. And then in the late 80s, of course, the drought of 89 was a disaster year for MASC and many farmers. So premiums shoot right up, and we've had some challenges through the early 90s, lots of fusarium head blight, that sort of thing. But then that started to drop off in the late 90s, and premium rates followed along and dropped off accordingly. Early 2000s, we had some good years, and then 2004 and 2005 hit. Again, huge spikes in premiums again. 2011 hit again to do that. Since then, generally speaking, pretty good years. Bit of a spike here after our drought in 2021, but that's exactly the way the program reacts. We try and offer as low a premium as we possibly can, but we need to react once we have some lost years, and that's what it's showing. And over this, 60-year time frame, not a lot has changed from a risk perspective at MASCs. When I talk about percentage and being pretty flat, depending on the perspective, if you're a farmer, you're saying, yeah, it was 8% in 70 and it's still roughly 8% now. That doesn't make any sense because I paid $2 an acre for a premium back in the 70s and I'm paying $8 or $9 now. So rate is not necessarily what you pay per acre. It's a rate based on the percentage of coverage that we offer. So what's changed, and these black lines are basically what our liability is at MASC. And you can see back in the 90s it was a lot lower. The last 10 or 15 years our liability has climbed through the roof. So it's a percentage of the coverage we offer on a per acre basis. So if your rate is, or if we offer you coverage of $500 and your rate is 10%, you're paying $50 an acre and it's cost shared with 2 levels of government. Back in the 70s we were probably only offering you $100 of coverage. 10% of that is only $10. So that's why your premium per acre is perhaps a lot higher than it used to be. It's because the coverage you're getting is a lot higher than it used to be, even though the rate itself hasn't changed a whole bunch. Last couple of slides, if you're kind of a data nerd and you want to see what MASC has to offer, we do have some data that's accessible through our website. If you go to what we call the Manitoba Management Plus program, you can get into some regional analysis tools, and you can get some yield data by variety. You can get some yield data by soil types. You just click on the one you want. When you get into there, you can pick a specific risk area or municipality if you want to. You select which risk area or municipality. You can select which crop you want. You can select varieties as well. And then you can select the years. So if there's a certain range of years you want to see, you can kind of select that as well. Just slide the bar, and at the end of the day, you'll get a bunch of data dumped to you. It's anonymized data, so you can't find your own farm in there if you're looking for your farm. That's not available. We certainly take a lot of pride in making sure that we don't disclose too personal information. But you can see data's grouped together and perhaps do some of what you're trying to study. I think that's the end of it. How are we for time? Oops.
Hey, upstairs, Amy.
Can we get her mic to go?
I got a green light and it's not working. I'm so sorry. Okay, we've got a few minutes for questions, so we can go ahead and fire away. That'll give us time for our.
There we go. Okay, great. We have some time for questions. I see a hand up there. I'll come right there. This gives us also a moment for our next speaker to get outfitted with his microphone, so that would be really helpful. And I see a question, so I can either bring you the mic or we can shout it out, but I think it's better to bring the mic to you. Get my steps in today.
How do the IPIs get buffered?
How do IPIs get buffered? So when we calculate a producer's IPI, we compare their average yield on their farm to the yield that other farmers in the same risk area and on the same soil type, A through J, what their yields were. And when we make that comparison, if farmer we're talking about, if their yield is 10% better than their neighbors, I'll call them, in the same risk area and soil zone, they'll have an IPI that reflects a 10% improvement. The buffering part of it limits how much your IPI can change year over year. And we don't allow a change more than 30% higher or 30% lower in any given year. And that's really a protection that if you're growing canola in one quarter section and it's just wiped out, you had a bit of an excess moisture situation and your yield is 0, you're not going to see your IPI tank year over year very quickly because of that buffering that's there. So that's the purpose of it. Same thing on the high end of things. If you happen to, for whatever reason, have a yield that's 50% better than your neighbors, we're going to limit how much your IPI can change year over year. The nice part about it, if I can say that, we allow it to catch up. So if we limit you in year 1, that sort of leftover limit could apply in year 2. So it does sort of catch up over time, but it's really a 30% limitation on how much it'll move in any given year.
Are there more questions? We have time for a couple more. If you're kind of marinating on a question, I am just going to remind everybody, if you're pursuing CEU credits, this session qualifies for 1 credit. So if you are pursuing those, up at the top of the concourse, you can sign up to prove that you have been here and collect those credits. Are there any other questions from the floor, from the audience?
Yeah, I have a question. You had some great data on historical canola yields there. Could you combine some of the data on, like the concerning one was the last 10 years of canola there dropping. Could you combine the data of farms that have 4 or 5 crops in rotation versus the yield data versus like a 2-crop operation?
Yeah, so we've taken a pretty hard look at crop rotation data in the last couple of years. Some limitations around our ability to do that, partially because the way we collect our data, we collect it on a quarter section basis. So we don't know for sure if a farmer's farming canola and wheat on the same quarter, canola and wheat on the same quarter, each 80 acres. Our data isn't specific enough to know if he's flip-flopping those 80s every year, or if he's growing canola on this 80 all the time, and wheat on wheat on wheat on this 80 all the time. Does that make sense? So we can make some assumptions in there, and we can, and it's easy when the whole quarter is one crop one year and the whole quarter is a different crop the next year. So we certainly can do some work around that. Can't say without a doubt we've got a perfect picture there necessarily. So we've done some of that, certainly, and we do recognize that tight canola rotations are problematic. I don't know that our data is specific enough to say 3-4 years is the perfect rotation or not, at least not to the extent that we've looked at it yet.
Last chance. And I'll just ask if you wave your arms because the light is shining in my eyes and I can hardly see who's all out there. Right. Seeing no more questions. Oh, we do have one more. You did wave your arm frantically. Thank you.
You could shout it out, yeah.
Shout it out.
Okay, with the tight canola, wheat canola rotations, is there a decline in yield showing up? Like with the tight wheat canola rotations, is there a decline in yield starting to show up? And an increase in disease compared to a farmer who has maybe 2 crops or 3 crops in between a cereal and the canola?
Yeah, it's a fair question. I'm not sure, again, that we've looked at it in enough detail to be able to say that definitively. I think intuitively that makes a lot of sense. I think what we're seeing here when we look at the big number picture, canola yields continue to increase, whether they're increasing more on wider rotations than they are on tight rotations. We haven't looked to that level of detail yet. Again, I think part of what we think our program does is if farmers are on tight rotations and the yields are suffering accordingly and their claim history is suffering accordingly, their IPIs are going to drop and their discount or surcharge is going to increase. So we hope that there's some inherent influence there for farmers to do the right thing at the end of the day, because they'll recognize that their IPI increases if they're doing the right thing and that their discount increases if they're doing the right thing. But I don't have the data off the top here to specifically show what that difference would be.
Thank you so much, David. But that's about all the time we have for questions. Will you be around at the show for the next little bit?
I'll hang around for a little bit for sure. Yep.
Sure. So if you have any burning questions for David, please take them out to the concourse. Thank you for your questions. And